Major funding for these broadcasts has been provided by grants from Madison Realty Capital, New York Community Bank, M&T Bank, AmTrust Title, Customers Bank, Ariel Property Advisors, Capital One Bank, Sterling National Bank, Marks Paneth LLP, Meridian Capital Group. Additional funding has been provided by grants from Amarant Bank, AVR Realty Company, Bank of America Merrill Lynch, Briarwood Organization, B6 Real Estate Advisors, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, Citizens Bank, Collins Building Services, CPEX Real Estate Services, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Kilroy Architectural Windows, Matone Group, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, RPW Group, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Merringore Family Foundation, and these friends. Oh, Crystal Apple. Oh, tell me what's going on. There's this thing called opportunity zones. Opportunity zones to invest in 87 different locations around the country. What kind of investment? Can I invest in an operating business? Can I buy a piece of real estate? Could I build a warehouse? Could I buy a franchise in Wendy's? I don't know the answers. So today I've assembled this group of business leaders to provide their insight on the opportunity zones. My guests today include the wizard of opportunity zones from the Midwest, Kansas specifically, the man who came from Dorothy and the Wizard of Oz, Dan Flanagan, the office manager in charge of the New York City office for Passanelli. From New York City, Mike Tortorici, who is a partner at Ariel Property Advisors. From Chicago originally, Steve Bookies, who is a tax partner at Friedman LLP. And from Connecticut, our Dartmouth lacrosse player over here, Fergus Campbell, a managing director at Samara Road. So who's going to explain what is this opportunity zone?
First, I'm going to say I usually have two bodyguards, a tax lawyer on this side and a tax lawyer on this side. I'm a real estate finance guy, but I can answer part of this question, and that is anybody who's got a capital gain.
Let's understand, I want to make this not inside baseball. A number of years ago, I bought this little company called Apple for $5,000, and I had a profit of $150,000. So I have $150,000 capital gains. Under the present tax law, what would I be paying? You're the accountants, right? You're the tax lawyer, so how much would I be paying?
So if you had $150,000 in capital gains, your federal rate would be about $30,000 plus state.
Okay. So what happens now?
Now, if you had that gain from January 1, 2018 on or after, then you could invest those proceeds or part of them into an opportunity zone fund that would in turn invest in a business in an opportunity zone and have some benefits. Those benefits would include a deferral of your tax recognition until December 31, 2026, possibly, depending on when you made your investment, an additional benefit of up to 15% reduction in your capital gain tax ultimately, and then...
Wait a second, how do I get that deal? That
well,
extra 15%? Wait,
Yeah.
this is an open discussion.
I mean, if it depends on the time frame of which you hold that investment in the fund. So if you hold, you take that gain from Jan 1, 2018, invest it into a fund, and you hold it in the fund for 5 years, you get a 10% discount on that initial deferred gain. If you hold it for 7 years, you get a 15% discount. But the trick is,
Give me the dollars and cents. You know, I'm thick. I want to.
so we have that 30,000
I had $30,000 profit
of gain you have to pay.
gain, right?
Oh, that's the tax
That's
you have
the
to pay.
tax.
That's
That
your
was
tax
the tax.
liability.
Tax.
So you get a 10% discount on that. So you get a $3,000 discount. And then if you hold it for 7 years, you get a $4,500 discount on that.
And if I hold it for 10 years?
That's a different benefit. But this deferred gain at the horizon of 12/31/2026, you have to pay, regardless of if you sold the investment or not.
Now, I live in New York State. You talk to me about the federal taxes. What about the state taxes? Am I obligated to pay some state taxes?
As of now, most states are following the federal law. New York, I believe, is following it. So if the gain is deferred for federal purposes, it's deferred for New York purposes until December 31st, 2026.
You handle a national world. Do you see most states allowing it to be deferred?
Yeah, most are. It's interesting. It's running into some trouble in California,
Right.
and that's a very significant place for it to run into trouble because I think it's the highest state capital gain
Right.
rates in the country.
I heard about my capital gain that I had over here. Where's my opportunity zone? I read somewhere that it said 8,700 locations around the country, in the Midwest, in Cleveland, in Memphis, in Nashville, also in the Bronx,
So
also in Brooklyn.
yeah, so in every borough, Manhattan even has a couple of very small opportunity zones. But in Upper Manhattan, there's East Harlem is one of the bigger beneficiaries. Inwood, Central Harlem, the Bronx, the South Bronx in particular. There's huge swaths that are covered in opportunity zones. In Brooklyn, you've got downtown Brooklyn even has some, as well as the Gowanus area that's about to be rezoned. East New York, practically all of Jamaica is an opportunity zone, which is very interesting. Even parts of Flushing, parts of Long Island City.
What's the rules with the money? I got this $100,000 gain that I had, in my stock market. Do I have to give it to this guy over here today? What's the mechanics? What's all the scenario over there?
In terms of the timing and
Yeah, and the timing. I know about the money where I'm gonna. The market's up to this high
Sure.
level right now. It really sounds good. It's a good opportunity. You're my advisor. Friedman's my accountant. Tell me what I should be doing.
Within 180 days of realizing the gain, cash up to the amount of the deferred gain needs to be invested in a qualified opportunity zone fund. At that point, the gain is deferred until December 31st, 2026. And if the holding requirements are met, 15% of the gain completely escapes taxation.
So what happened if I sold the stock last year?
You'd have 180 days from the day that the stock was sold. So if you sold it, say, in November of 2018, you'd have approximately 180 days, which would bring you into May of 2019 to invest the capital.
So if it's after May it's no good.
At that point, the gain cannot be deferred. And even though the cash is being invested in 2019, it would be a deferral on your 2018 tax return because that's the year that the gain was realized.
So
Interesting. One exception, though, if you're in a partnership, the partnership's got a December 31 year end, 2/18. You've got until about June 28 or 29, I forget
Right.
exactly.
So even if the partnership sold it in the summer of 2018, you don't really get hit.
You
until
get the
your K1 at
benefit
the
of
end year.
the.
all this talk and all these things, who is this Opportunity Zone fund? Tell me about who I'm dealing with. I don't know anything. Somebody called me up on the phone. It's like these former people saying, buy a mutual fund. Who are the people out there? You're an Opportunity Zone fund. Who are you?
We're structuring Opportunity Zone funds. And I think the fund is a misnomer to a degree because people hear a fund and they think it's a
They think
diversified
the
pool.
Oppenheimer fund.
Right.
Or the First Fidelity fund or the fund.
But it's just terminology. And a qualified Opportunity Zone fund is really no different than any LLC
So-
you would use for an investment.
So me and the Wizard of Oz over there.
You guys have big gains?
No, I'm talking my friend over here. If we decided to create a fund, okay? because I'm in the real estate business, he's in the real estate business. We decide that we're going to be a fund, okay? And we're going to go to Mike to find us some property. What's the rules? Who could create a fund? Are there any requirements? Are there any fiduciary rules? How do you feel comfortable with the fund?
That's one of the things I think they did best in the regs. You know, there's been different tax incentives in history that have been super complicated and very hard to qualify, making it hard for smaller individuals, investors to utilize the benefits. But it's a self-regulating, self-certifying vehicle. And you have to file a form with the IRS, and you have every 6 months, you have twice a year compliance test.
There's asset testing. So to elect to be an opportunity zone fund, the entity with its tax return for the year in which it's electing to be an opportunity zone fund attaches a form electing to be a QOF. It's as simple as that. There's no application process. There's no approval process. There is an asset and income test.
But what happens if, I like him, but what about this guy who called me up, he specializes in opportunity zones in East New York section of Brooklyn because he lived there. He grew up there. All of a sudden, he's an operator. He's going to take my money and he's going to put it into a different opportunity. Or he's in East Harlem and he's at the El Mercado, okay, and he's investing in a new restaurant business.
Well, it's like any other investment. You better do your due diligence in every aspect of it. But point I want to emphasize is, despite all this noise about the big funds, most of the deals that are being done by us, and I think by everybody, are one or two individuals or a small group of individuals who've got a capital gain. Some of them are in the real estate business, most of them anyway, and they've got one particular project that they want to do, a small apartment building or office or warehouse, whatever it would be, and they create a fund. They put the money into partnership.
Wait a second, but isn't there a rule? I put the money in, and then I got to double down. I got to put more money in.
It depends on what it is. If it's an original use, so-called, you don't have to double down. If it's an existing building, you have to do substantial improvement where you double down, and over a 30. I get the 30 and the 31 mixed up all the time.
30 months.
Yeah.
But to your point, I mean, the people that we've seen actively pursuing opportunity zone properties, it's traditional developers, experienced developers that can create and execute a very good business plan, but their capital is different and their sources of capital is different. And in some cases, they're looking to potentially stretch on price if a deal makes certain sense. But I think that the premium that some people are talking about so far is very select. Very select sites can see that type of activity.
A true operating business, okay? I'm planning to open up a restaurant or a retail store, okay, in one of the 8,700 opportunity zones within and around the country. What are the rules?
A one-location restaurant.
A one-location restaurant.
That's doing a new restaurant that's actually coming into the zone or building something from scratch or doing something from scratch can get in there and take advantage of that. There's a couple rules that apply. They have to, and this is one problem that's holding people back right now, that people believe is going to be resolved soon, but hasn't been resolved, and that is a requirement for that 50% of the gross income of the business has to come from inside the zone. That works well for that one restaurant. Shouldn't be any problem with that.
But what
that
if
restaurant wants to expand?
I recently did a 10-10 Wins report about the increasing of number of barbecue restaurants opening up in the city. Okay? If I'm an operator and I want a franchise and I own a business and I put the money over there in this and they go into other areas, it's only for the operation in that opportunity zone, it sounds like.
Interestingly, if it's a pure franchise, you're selling intellectual property, not hard assets. So you could have your operation in the opportunity zone, and again, there's complications to it, but have a franchise. On the other hand, if you're actually operating physical restaurants, you have issues about that. You have a lot of property outside of the opportunity zone. What you can do perhaps is create a bunch of subsidiaries, really complicated,
I'm
do
so
things.
I'm so crazy right now. I still don't understand anything.
That's why it's the lawyers and accountants relief.
I know that's exactly
And
right.
that's what we're still waiting on round 2 of the regs from the IRS.
Okay, so tell me about your company, what you do, and where you said you've done a couple of funds right now.
Sure. I mean, so Mara Road's it's a real estate PE firm based out of New York. We're investing, all across the country, primarily secondary and tertiary markets, with a focus on revitalizing the urban cores. We have a strong belief that the millennialization we're seeing across the country is going to drive growth in some of these lagging markets. So prior to opportunity zones, we were already investing in cities that have seen big swaths of opportunity
Let's talk
zones.
about now, specifically what you do
now-
in opportunity zone.
So now we did 2 deals in Nashville previously in the Gulch, not an opportunity zone. Like the market started looking more broadly, we're doing a deal in Nashville in Wedgwood, Houston. It is a repositioning of a vacant industrial building that we're converting to creative office and bringing in an office tenant. The reason it works well from an opportunity zone perspective is, we have great downside protection in our land basis. The building needs the improvement dollars, the substantial improvement dollars, to meet the test to qualify to be an opportunity zone investment. And we believe in the long-term growth.
Substantial improvement is how much?
Substantial improvement is,
Percentage.
it's dollar for dollar the building value. So you take your purchase price, allocate between land and building, and you have to.
Okay, so if I'm
substantially
buying
improve.
something for $10 million, I have a $2 million land value, so it's an $8 million value. I have to invest another $8 million.
Another $8 million.
And how long of a period of time do I have to invest? that
30
$8?
months.
30 months. What happens if I need more money? I need more money later on. This tenant that we put in, everything was fine, but they were in the pharmaceutical business, and they found out that the product didn't get the FDA approval, and now they went out of business. So now I don't have the money. What happens now? I need more money to go into this business.
There could either be a capital call, and if that capital call is funded with deferred gains, the benefits would attach to it as long as the investment was made prior to June 30th of 2027, or the fund itself could finance, could seek financing for the additional capital that it needed.
And what happened if I bought the property from Mike, okay, found me a piece of property in East New York. I built a warehouse on this property in East New York. It's a good example because I think it's realistic. Okay, I bought this vacant land. I bought a last mile operation and put a warehouse over there. And I got lucky. I got Jet or Amazon or someone like that or a freight forwarder to operate in this situation. And now I can go out and I can find a bank who wants to finance me. What happens over there? Can I get the money? Can I use the proceeds, that Mike found for me? I bought this property, this $10 million property in East New York. I put in 16 million, I put $10 million, the $2 million basis. I put $8 million plus another $8 million. Now I got this great tenant, and I have all these banks coming to me to say, finance. What happens with
Now you want to refinance
I
and
want to
take your
refi-
money out, right?
Yep.
Or finance and take your money out. That's unclear. We believe that there's going to be some ability, but maybe not perfect, for getting that money back. The speculation is that they'll allow the increase in value from the time you acquire that building to be taken back out again through a financing, but maybe not what you've invested in it, because you're supposed to have your money in there for more than 10 years for it to work. But it's unknown right now.
Okay, so now I'm going to make it even more complicated. Okay, I went to Samara Road. Okay, I like the guys over there. But my client and friend was 85 years of age when they invested over there. Unfortunately, they passed on. What happens to the next stage, the estate?
It's unclear if the fund owner passes on prior to December 31st, 2026. It's thought that the deferred gain would be income in respect of a decedent that would be.
No,
picked
it's
up
not.
by
I'm not the fund owner. I'm an investor. I invested in.
Yeah, but that's...
The investor in the fund, I think.
Right.
Yeah, I was speaking to the investor of the fund.
Right. So what happens to him? Estate taxes?
It's thought that it's unclear. There's no guidance on it, but it's expected that the deferred gain would be income in respect of a decedent, which would be picked up by the beneficiaries of the estate or the estate itself. I
So
don't know
bad news right now is unless they do something, the estate's not going to be able to get those benefits, is my understanding. I'm feeling a little bit on thin ice on that answer, by the way.
It's still, that area is still very unclear.
Let's look at it this way. Let's take a different person. It's like somebody who won the lottery. You know, they made the money and they got lucky. They found the stock at the right time, but they need some of the money. They gave you the money, and unfortunately, their circumstances, their life circumstances, didn't work out. What's my liquidity? Can I get my money back?
They could always sell their interest in the fund, but if they were to sell out early, they would have to pay the deferred gain.
Is there liquidity in funds?
It depends on the fund.
Yeah, and there's not much now, but think of, you know, there's a finance market for capital commitments to partnerships and LLCs. I think a whole financing infrastructure will develop around this if it becomes big enough.
Have you seen new people who wouldn't come to you before getting involved, looking at areas specifically because of the opportunity zone?
So we're in contract right now on a property in the Bronx, and the site, pretty big site, it lent itself to educational use and medical use in addition to being some kind of affordable housing play. And we saw investors from Manhattan traditionally, from Brooklyn traditionally, venture up into this North Bronx location, and ultimately they pushed the price up beyond what we traditionally see in the Bronx, well over 100 a buildable foot. For if you're looking at affordable housing in the Bronx today, you're probably on the very high end looking at $85 a square foot if there's some level of retail or something like that to it. Usually it's more around $60 or $70 a buildable foot.
You know, there's been a lot of money going into prop tech for real estate in the last couple of years. I mean, it's significantly billions of dollars being over there. The guy has 2 AI products that have done well, and he has the intellectual property in these 2 products. And he comes to me and he says to me, I would like you as an investor in the program, okay? What would be the requirement? He wants $500,000, let's say, hypothetically from me. And for that $500,000, I'm going to get, let's say, a 5% interest in the business.
Right. It can be. I don't know if I said it here or elsewhere, but we're actually working on a deal way out in the boondocks, in the heart of the country, back where I come from. A deal where a capital-strapped company in trouble for that reason is in an opportunity zone. Now, first of all, those already in an opportunity zone can't really take advantage of it. However, they can if they sell, and if they own 20%
right, but
or less.
I'm not talking about selling. I'm talking about a new business, because each and every day there's new prop tech companies coming around. You know.
Sure.
You know that they come.
I thought your example was existing, but
No, I'm
new's
talking about
different.
new.
Oh yeah.
A new business, but basically the business is really being spent not in actual dollars for property or anything else. The money is being spent in operating capital to run the business.
There are some complex issues about how that's staged, but you definitely can do it. And there's this so-called working capital safe harbor, which that's 31 months, right?
Yeah, 31 months.
Yeah, right. That's where the 31 versus 30
No,
comes in.
I mean, I see that as a great area for VC money going into investments.
The investment is so focused on real estate at this time because it's clear. As we can tell, operating business is not clear. But long term, the potential 10-year exemption everyone's fighting for could be a lot bigger when we're talking about, tech startups and in VC world, because those you could invest and sell for 100x, where real estate,
The city of Newark has a lot of prop tech companies over there, who are in that area, and the entire city of Newark basically is an opportunity zone. So you take a person who would be running a business out of Manhattan, and they say, hey, go to Newark. They live in Jersey City, Newark, or somebody like that. They make an investment in the company. They take their stock capital gain that we're talking about. Could be a win-win on both ways because the profit over there.
Yeah, we're handling two different New York-based funds, one of which is going to invest in digital infrastructure companies in the blockchain cryptocurrency world, and the other one is a more traditional tech incubator, startup, VC type operation like you described. They're already ready to do this. It's pretty scary right now because some clarification's needed, but that's coming soon. The guys who wrote this legislation are pushing really hard on the IRS and the White House to clarify, to make this good for operating. This was supposed to be for operating businesses, not primarily for real estate, but real estate's the low-hanging fruit here that's easier to
But real estate people have I hate to use the cliche, they have the opportunity to invest in a 1031 exchange, a like-kind exchange. But over there, in essence, Apple, you are dull. You're not shiny, and because it's really questionable, all the rules and regulations. So as you know, today, as we did an update on Opportunity Zones 101, I know and in the future I'm going to have to come back and bring up more discussions on Opportunity Zones. I'd like to thank, as I proverbially call him, the Wizard of Oz, Dan, Mike, Steve, Campbell, and I'll see you next week.